Every second, financial markets generate a barrage of data. Millions of transactions manifest as erratic spikes on a chart, creating an environment defined by chaos. Staring directly at this raw price action is deceptive. The sheer density of the noise obscures the actual vector of the asset, which often pushes traders into making emotional, reactive decisions instead of calculating the probabilities. To strip away the noise and locate a clear signal, quantitative analysts rely on a specific mathematical filter, linear regression. This chart displays a standard price uptrend. A subjective, hand-drawn trendline simply connects arbitrary lows based on a trader's opinion, but a regression line calculates the mathematical best fit for all the data, anchoring a vector straight through the center of the path. Applying this calculation removes opinion from the equation. It translates the visual interpretation of a chart into an objective, measurable statistic. This chart shows 140 years of S&P index data, proving how regression holds up across eras. The red line marks the historical equilibrium. The blue line shows price deviating, like the 1929 peak at 81% above trend, or the 2000 bubble at 152%. Analysts extract historical variance by calculating the exact distance between these extreme peaks and that central regression line. Tracking this specific distance yields a probabilistic map. It helps distinguish between a temporary snapback to the mean and a move strong enough to reset the market's long-term baseline. While day-to-day fluctuations appear chaotic, this century of data demonstrates a consistent tendency for price to revolve around a quantifiable central vector. To build algorithmic boundaries around a market, we must first deconstruct the underlying baseline, specifically ordinary least squares, or OLS. This scatterplot displays blue data points across an x and y axis. A regression algorithm locates the exact mathematical center of this distribution and draws a central fit line. The formula achieves this by strictly minimizing the distance between the line and every single scattered data point. The shaded 95% confidence band bounds the data, proving the line has found true equilibrium. Once the calculation locks in the line, the next variable is its angle. The slope of the regression line acts as a pure mathematical measurement of momentum. This candlestick chart measures slope through different phases of a move. We can see the angle shift from 45 down to 27 and then sharply up to 62 degrees. A steep 62-degree uphill trend confirms massive structural momentum, while a flat 27-degree angle indicates the market is moving sideways. Extracting the exact slope mathematically replaces the vague feeling of a strong trend with a pure, actionable metric. The central regression line maps the direction, but price rarely stays perfectly on the vector. Markets breathe. They operate in ranges and require parallel boundaries to frame that movement. By duplicating this central regression line and shifting it upward and downward based on historical price highs and lows, we create a channel. This is the INFI daily chart, visualizing a complete regression channel. It operates as a distinct map of fair value and statistical extremes. The middle line represents fair value. The upper green band marks an expensive, highly stretched state, while the lower red band indicates a discounted state. Think of this geometry like a highway lane. Price action naturally seeks equilibrium and travels within this specific bounded corridor, bouncing between the edges. The regression channel creates a definitive zone where price is considered mathematically stretched, making departures from the mean highly actionable. Rigid regression channels have one distinct flaw. Their walls are fixed. They fail to adjust when market volatility rapidly expands or contracts. This Tesla stock chart shows standard deviation bands, which solve the problem of variable volatility. Instead of straight lines, these bands are dynamic. They pinch during calm periods and expand based on price action speed, acting as an elastic boundary. These bands provide a precise measurement of the normal distance price travels before the probability of the trend continuing drops significantly. Like pulling back a rubber band, the further price is stretched from the moving average to hit these dynamic extremes, the harder it typically snaps back toward the center. Standard deviation replaces rigid walls with mathematical elasticity, accurately defining the true limits of variance in real time. All of these measurements lead to a single core decision at the edge of the model. What happens when price violently strikes the outer statistical band? This candlestick chart shows mean reversion. An overextended market exhausts itself and returns to the center. A boundary strike alone isn't enough. Combining it with a momentum oscillator, shown here dropping below the RSI 30 line, confirms the exhaustion necessary to trigger the trade. But exhaustion is only half the equation. The second state is trend continuation. Take a look at this Bitcoin chart. Under conditions of extreme volume or fundamental shifts, the statistical elastic breaks. Price shatters the filter trend line and triggers a rocket move into entirely new price levels. Differentiating between a bounce and a breakout dictates how a system engages these statistical extremes. Analysts do not sit and manually hunt for these setups across thousands of charts. They code these mathematical parameters directly into screeners. A screener rapidly processes massive data sets. It can instantly output a list of assets exhibiting a high slope for trend following, or flag assets resting precisely on their lower band for mean reversion setups. This automated filtering removes human emotion from the equation, forcing the trader to rely entirely on the objective statistical geometry established by the code. By measuring the slope, defining the channels, and mapping the variance, traders stop guessing at the noise. They elevate themselves from subjective observers to objective system architects.